By now, most American taxpayers are aware of the fact that a lot of new laws have been put in place to make sure that the U.S. taxpayer is reporting all of their offshore income, reporting their offshore assets and their offshore bank accounts. Up until very, very recently, there also was a program instituted that made it very painful for Americans who had not reported foreign income in the past and who had foreign bank accounts that they had not reported. There was serious penalties, and all of this was backed up by the IRS's ability to even assert criminal charges against people who hadn't reported all of their offshore income. It's been several years living under that regime for people, and then only very recently the Internal Revenue Service has decided to really make life a lot easier and give Americans a chance, Americans and or U.S. taxpayers of all types, give the taxpayers a chance to report their foreign assets, report their foreign earnings, and not have to go through this rigorous penalty situation. The only caveat in all of this is there's a new regime, and we're going to discuss the new regime, and we're going to discuss how liberal it really is and how beneficial it is. However, there is one caveat. This is not going to apply to U.S. taxpayers if the Internal Revenue Service can prove that you were willful and your conduct or misconduct was willful misconduct, and you were well aware of the fact that you should have been making reports and didn't do it. So what we're going to look at is both the new regime, so their taxpayer can understand what's necessary to comply with it, and we'll also take a look at what does the IRS mean when they talk about willful conduct, willful misconduct, and failure to report both revenue and to report on foreign assets. First, let's look at the new regime, which came into being June 18th of 2014. So it's a very, very recent, and it's important to get the word out on this. The IRS came out with a new regime called the Streamlined Filing Compliance Procedures. The Internal Revenue Service announced major changes in its Offshore Voluntary Compliance Program and provided new options to help taxpayers, U.S. taxpayers, who live in the United States and those who reside overseas. The changes will provide a new avenue for tens of thousands of Americans to come into compliance with foreign reporting requirements at a very reasonable cost. Again, the warning is that these new streamlined procedures are not going to apply to people who have willful misconduct in their failure to report their offshore assets. The purpose of the streamlined procedures is to permit the Americans to file amended tax returns and report their offshore income, and to file all of their information returns, which are not tax returns, but returns that provide the U.S. with information when people have offshore assets. There's general eligibility requirements that we'll look at. The streamlined procedures are available to both U.S. individual taxpayers that reside outside of the United States and U.S. individual taxpayers that reside in the United States. Taxpayers who are going to use this streamlined procedure are going to have to certify that their conduct up until now has not been willful. Those whose conduct is in their failure to make reports and to pay taxes on offshore income, who are considered to be willful, will not be eligible for this. Now that includes people who already have civil examinations going on their ongoing right now, and taxpayers who have criminal examinations by the IRS also will not be able to use the streamlined procedures. Now, one thing that is very helpful is many taxpayers, once they found out about the serious penalties which started in 2009, they attempted to do what were called quiet disclosures, meaning that they didn't sign up for the various IRS programs that had been instituted, which allowed them to report their foreign earnings and their foreign assets, but exacted a very stiff penalty when you did report it. Instead, these are people who went ahead and filed their U.S. taxes and reported their offshore income, but never tried to get into either of these programs. These people who filed were filed what the IRS was calling quiet disclosures, and the IRS was coming down very, very heavy on people who filed quiet disclosures and did not get involved in their offshore programs that required the payment of penalties. Well, the IRS is now permitting all of those people who filed quiet disclosures to be able to go into the Streamlined program, which will be still a bit costly, but will make sure that the taxpayers who are qualified for the Streamlined program don't have these big problems hanging over their heads of major penalties and criminal penalties in the event things go wrong and there are willfulness problems. So for those of you who have filed the quiet disclosures, you need to take a good hard look of joining this program, even though it may appear to you that your quiet disclosures were successful, because you never know when it's going to come up and bite you. Also, there is the ability of those individuals who got involved in the IRS programs called the Offshore Voluntary Disclosure Programs. Taxpayers who are involved in the Offshore Voluntary Disclosure Programs, which now would make them subject to some high penalties, they are going to be able to file for the Streamlined program and not go through the Offshore Voluntary Disclosure Program, again, so long as they are not willful in their failure to file their returns or pay their taxes. And those taxpayers will be able to, in essence, so long as they have not yet filed a final resolution with the IRS, they'll be able, even though they're in the Offshore Voluntary Disclosure Program, they too will be able to go into the Streamline program and avoid the Offshore Voluntary Disclosure Program, which, as I say, is much more expensive. We're going to talk about the eligibility requirements to be in the program. And I want to make everyone aware that there's actually two different programs. One applies to Americans who live in America, and the other one applies to U.S. taxpayers who have really not lived in America and have been living offshore, have only some minor ties with the U.S. However, because they're U.S. citizens or green card holders, or have had certain amounts of time in the U.S., will have a different eligibility requirements and a much lower penalties, or actually no penalties at all, if you are non-resident to the U.S. and you're a U.S. taxpayer. First, let's talk about the eligibility requirements for those who are here, American taxpayers who've been living in America. First, they need to be resident, either green card holders, citizens, or U.S. taxpayers because of their time that they spent in the United States. And this first program won't apply to them if they are living outside the United States and have made their residency outside of the United States. Second requirement is that they have filed U.S. tax returns, and they are now want to comply and make sure that all of their foreign income is reported, and they have not reported that foreign income in the past. Third, they have not filed the appropriate information returns, such as the returns that require you to report your foreign bank accounts, and the more recent returns that have required Americans to report all of their foreign assets that produce income. The last requirement, again, is that your conduct has not been willful misconduct in your failure to report. Now that we've discussed the eligibility requirements, we're going to look into the procedures that have to be followed to comply with the new streamlined domestic procedures. And again, I keep stressing, and this is where it's important that everyone consult with a professional before they get involved in any of these programs. You've got to have your behavior in your non-filing reviewed by a professional, because the big decision here is to make sure that there is non-willful conduct, and to distinguish it from willful conduct, because in the event the conduct and the failure to file is considered to be willful misconduct, all that the taxpayer is doing is just getting involved in a program that could really knock him in the teeth, because you're disclosing all kinds of things and just putting in the Internal Revenue Service's hands whatever they need to proceed, and cost you a lot of money and expose you to a lot of penalties. So there's got to be a good look at whether one fits in the willful category or not before entering into the program. Now, assuming that you are a non-willful filer, or that you're not a willful filer, you're not willful in your failure to file, these are the procedures that are required. The first thing is to file 3 years amended returns for your most recent 3 years that you've reported. And that is not going to include a year in which it's still possible to report your income and it be timely. So, for example, The year 2013 is not yet closed from a position of someone reporting their year 2013 return. So you would not include year 2013 as one of your 3 years. You'd be looking at the year 2012, 11, and 10, because those are 3 years that the books are closed on, and you need to do those by an amended return. So first requirement is an amended return has to be filed on your 3 prior years that are closed, and you have to report all of your foreign income. Secondly, you are going to have to file any forms related to the reporting of foreign income. So anybody who's got a foreign corporation that they have not reported on, not only might you have to report the income on that, but there's information returns where you have to file and provide the IRS with information on the foreign corporation. There's also a brand new, relatively new return, the Form 8938, where this is relatively new, and it required Americans to file and report any foreign assets that result in income. Now, even though this form didn't come out until recently, you are going to be required to include this form with the amended returns that you file, even though the form might not ordinarily have been required, let's say for the year 2010. In order to be in the program, you are going to have to file those forms. Next, you're going to have to file your foreign bank account reports, if you haven't filed those foreign bank account reports, for the last 6 years. And third, you're going to have to pay a penalty. This penalty, however, is a greatly reduced penalty from the Offshore Voluntary Disclosure Program. You're going to have to pay the full amount of your tax and interest on all of the foreign income that you report that should be in the amended returns. And you're going to have to pay an offshore penalty, but it's equal to only 5% of the highest aggregate balance of your foreign assets. And so this will be any assets that are reported on this Form 8938 that requires you to report all foreign assets. All of that is going to be lumped together, and there's going to be a 5% penalty on there. However, what will not apply will be certain accuracy penalties that normally will go along with late filings of information returns and tax returns. So as you can see, this is a greatly reduced penalty, and the new program eliminates a lot of other penalty potentials. These requirements, once met, are just going to be fairly smooth sailing. However, the IRS is still retaining the right to audit these things and examine them, both the information returns and the tax returns. So if you're going to join this Streamlined program, do it the right way and make sure everything is disclosed. Now, some of the just procedural things that need to be done is when you enter the Streamlined program and you file your amended returns, you need to indicate on the amended returns that this is part of the Streamlined program. And then you're also going to have to certify that you are eligible for the program, that you've now filed all your foreign bank account reports, that you filed any other required information returns, and that your conduct is not willful. So you're going to be certifying under oath as to all of these things. So you want to make sure that you are complying with all of these. You're also going to have to submit your payments right away along with your amended returns. And that's the payments both for any taxes that are due, any interest that's due on those taxes, and the offshore miscellaneous 5% penalty. A check's got to go in with these returns. Unlike the Offshore Voluntary Disclosure Program of the past, where you would file and often just pay your taxes and then wait to see how much of a penalty you owed, this time the money's got to go in or else you're not in the program. Now the requirements are very similar for people who are living outside of the United States. However, there are some differences that are very important. The biggest difference is that if you are a U.S. taxpayer and you haven't been resident in the United States, you're going to have to make all the same filings. However, you're not going to be subject to the 5% penalty, which is another very, very liberal treatment of all of this, and people need to take advantage of it. That's pretty much the bottom line on these the new streamline requirements. There's several details that I really want to not weigh us down in details, because this is a new program. I want to make sure the information gets out and we can provide a lot more details as things move on. But that's the heart of the program. And now what I want to do, because I've been stressing how important it is that if you're going to be in the program, you need to be a non-willful late filer. I want to look at, and there's a lot of cases on this. There's a lot of IRS procedures. There's an IRS manual that spells out a lot of this. But I want us to take a little bit of time and look at the concept of willfulness. Now, this is really an incomplete description of the concept of willfulness, but I think it's important to just kind of introduce you to the mindset of what the IRS is looking for. The test for willfulness is whether there was a voluntary, intentional violation of a known legal duty. And the IRS has to prove willfulness. That's the burden of the Internal Revenue Service, not the burden of the taxpayer. But if the IRS can prove it, then the burden shifts and the taxpayer's got to prove otherwise. The IRS own manual is very helpful, and I'm going to quote some of the things from the manual. According to the manual, the innocent failure of an unsophisticated taxpayer to know the filing requirements for international transactions, coupled with other factors such as the lack of any efforts taken to conceal the existence of the accounts, would generally not lead to a finding of willfulness. The mere fact that a person checked the wrong box on a tax return is not sufficient in and of itself to find willfulness. Willfulness is a state of mind, so it's not really provable so much with direct evidence. It's usually established by drawing reasonable inference from the facts. The government may base a determination of willfulness on the failure to file foreign bank accounts from the fact that income has been concealed, actively concealed, and this means concealing transfers to foreign bank accounts, concealing signature authority in different transactions that might require you to reveal this. Taking some more examples from the IRS and also going into the idea of what circumstances are mitigating circumstances, or what criteria might be used to show that someone was not willful. I'm going to keep reading or paraphrasing from the IRS manual. When a penalty is appropriate, the IRS has established that there are mitigation guidelines. An examiner may determine that a penalty under these guidelines is not appropriate, or that a lesser penalty amount can be provided. Factors that are considered by an examiner are whether this is so much bad faith shown, or rather so much good faith is shown, that it's really not necessary to come down all that hard on somebody, and a warning letter might be just enough. Whether the person has received a one warning letter already and still considered to continue to not do the right thing. Also, a mitigation factor is how cooperative a taxpayer is if there is an ongoing examination. There are 4 criteria that the IRS mentions that are criteria to be considered in non-willful failure to file. 1, the person has no history of criminal tax or other tax convictions for the preceding 10 years. Number 2, that no money passing through any of the foreign accounts is associated with any kind of illegal source or used to further a criminal purpose. Number 3, as I mentioned, cooperation by the taxpayer. And number 4, that the IRS did not determine a fraud penalty against the person for the underpayment of the income tax. All those are what we call the mitigating factors that help show that someone has not been willful. Finally, one little commentary on non-willfulness. It wasn't really until 5 years ago that the IRS began to actively get involved in this. There's been a need for the IRS to educate the American people. There's a lot of American people out there who had foreign bank accounts and didn't really realize that taxes might be due, or certainly that information returns might be due. But we are at the point right now where it's 5 years after the IRS has really woken up and been putting out a lot of information. So there's still some room for the unsophisticated taxpayer to claim their ignorance, but that room, that window is getting smaller and smaller and smaller. And so I think everybody needs to keep their eyes open about this, because the mitigating factors, they're going to be less and less available as it becomes more and more common knowledge that Americans must pay tax on their worldwide income. They must report their worldwide assets that lead to this. And for a lot of Americans, it's important that you know that American, when it taxes your foreign income, is not going to assert a double tax on that foreign income. So if you've paid taxes in other countries, you're going to be able to get a tax credit against the taxes you've paid in other countries. So any holding back on reporting U.S. income for fear of double taxes, that should not be in the forefront of anybody's mind, because if you're in the hands of a good professional, you're going to find that if you've been paying taxes overseas, if you've lived overseas and made wages, and there's several exclusions in the Internal Revenue Code that going to make it so that your tax burden on your unreported income is not going to be that burdensome on you. I know this has been a very short report. I want to thank everybody for listening, and in the future we'll be fleshing this out in a lot more detail.